be careful. What seems like a smart retirement decision today could turn into a financial trap tomorrow. We're always told that regular 401 kiloseconds and traditional IRAs are the best way to save for retirement. But what about the hidden problems that come with them? In this video, I'll explain why these accounts can become a burden and what smarter alternatives you should consider. There's a joke financial advisors tell that perfectly explains the issue. They say if all your retirement money is in a 401k or a traditional IRA, every time you buy gas or a loaf of bread in retirement, you're paying ordinary income tax. That's because every single dollar you withdraw from these accounts is treated as regular income. I don't want that for you. So that's the first big problem. Every withdrawal from a traditional 401k or IRA is fully taxable as ordinary income. There's no flexibility and no tax advantage when you actually need the money. The second major problem is required minimum distributions, or RMDs. Once you hit your early to mid-70s, the government forces you to take money out, whether you need it or not. When people do the math, they're often shocked by how large these forced withdrawals can become. These RMDs can push you into much higher tax brackets and completely wipe out the benefit of saving in a tax-deferred account in the first place. If your tax rate in the future ends up being higher than when you contributed, you've actually made a costly mistake. The third issue is legacy planning. Traditional retirement accounts aren't great for leaving to your children. When your kids inherit a traditional IRA, they have to empty the account within 10 years. By then, they're probably in their highest earning years, meaning they're also paying the highest taxes of their lives. That combination can destroy a large portion of the wealth you worked so hard to build. While they have some flexibility on when to withdraw, the pressure is still on. This is why many experts now suggest giving with purpose during your lifetime, when your children might need the support most for a first home, education, or just a better quality of life. There's a fantastic book on this called Die with Zero by Bill Perkins. Another critical issue is that traditional retirement accounts don't get a step up in basis. This means your heirs miss out on tax advantages that other types of accounts can offer. So, what should you do instead? One popular approach is diversifying across 3 buckets: a traditional retirement account, a Roth account, and a taxable investment account. This structure gives you control over your taxes instead of being controlled by them. But here's another strategy to consider. What if a portion of your long-term investments were in a taxable account, invested in broad market exchange-traded funds, or ETFs? As long as you don't sell, you generally don't trigger taxes. And in retirement, long-term capital gains are often taxed at much lower rates than ordinary income. In many cases, the tax rate can even be 0. The biggest advantage is that taxable accounts currently receive a step-up in basis at death. This can significantly reduce the tax burden on your heirs, and there's no forced withdrawal timeline. These are powerful reasons to think carefully before putting all your money into traditional 401k and IRA accounts. The key takeaway is planning. Don't make decisions blindly. Work with a qualified fiduciary advisor, an accountant, or use reliable planning software to model different scenarios. Your retirement strategy should fit your life, not limit it. If you found this video helpful, please give it a like, subscribe to the channel, and turn on the notification bell for more smart financial insights. This was TrendPoint News.